The Hedge Resourceman here. It's January the 9th, 2024. First of all, thanks to the sponsors. Let's look at the markets appear to be down a bit. Commodities kind of mixed. I guess silver's down. Whatever, I don't pay much attention. This is the first time I looked at the metals today, I think. It's like I take that as a very good sign. I mean, the bear market really teaches people about patience. That's one of the good things about bear markets, because you're kind of forced to be patient, unless you are impatient and actually sell out when it's cheap. But then obviously you are not patient. But I mean, I think that's how it's supposed to be, really. I mean, in my opinion, especially as a value investor, whatever, it's like most of your cases should be long term. Because we're waiting for a sentiment shift, and that could be, I mean, a major sentiment shift. Juniors have been doing a bit better last couple of months, but we're still waiting for the big the next big bull run, and we have no idea when that's gonna start. Could be tomorrow, could be in 6 months, could be in a year, whatever. So by definition, you hold as long as it takes for that to happen, and in the meantime, you invest or you pick companies like it's a perpetual bear market and have the conviction that it's a perpetual bull market. I mean, I really do think that if you put 98% of your time and effort into the micro, meaning actually stock picking, I mean, in that case, the next big bull run will come as a nice added bonus. That's how I like to do it, at least. I mean, yes, the beta plays will be the ones that do best, typically, from bottom to top. But I just can't stand just holding pure beta plays for years, let's say. Especially, I mean, I really can't hold crappy beta plays. It just feels so weird to be an investor in something is a subpar project, or really not going to be a mine at any point in time, but it's just for the beta that people will buy it up when the bull in whatever commodity gets going. I can't do that. I do feel very comfortable buying and holding, being a shareholder of something that I think is a legit play, that I'm buying in real value and I'm paying very little for it. That kind of stuff I can I can be patient when it comes to that. So I thought I would start off with a few concepts. I think it's getting more and more, or we have had a few good examples recently. With assays, expectations, drill stories, what happens on news release day, what happens after news release day, how should one think. These are just my personal opinions, as always. One thing is, like, do you want high or low expectations going into let's say assay results, or a catalyst? That could be both negative or positive or neutral, whatever. I think it's a bit, I was gonna say contrarian, but it's like I can't come up with a word right now, but typically it feels good to see a ramping price going into assay results, even if we have shares in that company, even if we're holding into assay results, we're taking assay risk. It somehow feels better to see everybody, well, not somehow, I mean, it's quite natural, but it feels good to see people with high expectations. Let's say you have a stock price that's been going up, so again, it's like you get that kind of confirmation from the market that it's patting you on the back. It's like it's rewarding you. It's like, yes, you've been a good boy. You've been a good boy. So it feels good going into ASI results, for example, with high expectations. Because you look smart on paper, because price has gone up. You see a lot of people agreeing that whatever you're holding is going to be the next big thing. In reality, we really want low expectations going into ASI results. Why? Because most people are short-term traders, and it's hard not to be, or at least short-term orientated. So if we have a bunch of people that are think that ASI results are going to be great and the stock is going to run after the ASI results, I mean, they obviously are in before the ASI results. Because they are dead sure, or not dead sure, but it's like they think, they hope it's going to be good, so I better get in before the ASI results, and then I'm going to get paid even more after the ASI results. What that means, again, like I talked about recently in another video, I mean, the more activity, the more chatter, the more people talking about it, it means more and more hot money is in the stock, meaning that they probably plan to sell, because a lot of people are just catalyst hunters, so they plan on selling on the next catalyst, especially if it's a well telegraphed catalyst. If it's a well-known catalyst, a lot of people know about the coming catalyst. Everybody knows it's, let's say, impact or whatever, and especially if it's a high-profile case. So that's really what we don't want going into ASI results. I mean, let's say this is going into ASI results. This is the chart of gold, but let's just pretend it's a stock. And everybody knows that around here there's going to be a catalyst, like ASI drill results. Obviously, this chart suggests that there's been a lot of buying. People have high expectations of the coming catalyst, and a lot of people believe that when the catalyst comes, the stock's gonna go like that, so they can sell. So they're focused on, or the plan is to sell at this well telegraphed catalyst. Well, since let's say there's been no news since this period here, so this is a ramp based on expectations of the next catalyst delivering a move like that. If you believe that the next catalyst is for sure gonna be a positive one, and you for sure think that, well, if it's a positive one, it's for sure gonna reward holders, then there's no price that is too high to pay, because wherever it goes, you assume that when it's released, it's going to jump up. So even if it ran up here, people are still holding and buying because they think it's going to go like that. Problem with that is that higher expectations, and given that 95% of people, especially retail, are short-term oriented and plan to just hold into a catalyst, that means the higher it goes, the more people will probably, or have planned to sell the catalyst, which brings up the uncomfortable situation where the higher it goes, the higher the expectations are, the more is priced in, and the more price to value risk you take to the downside, and less theoretical. I mean, the price to value on the upside has been getting more narrow. So it's pricing in more, higher chance of success, more the blue sky. It means there's a higher elevation to fall in case the results are bad, for example. And since there's so much pent-up selling demand, it means there's got to be, it's got to shock. I mean, it's hard to positively shock a market where the expectations are high. It means that the catalyst must be super good, if you know what I mean. And this is not about the long-term prospects or whatever. It's like everything is relative, and most people make decisions based on the short term and the next catalyst. So really, if we're a holder going into assay results, we ideally kind of want it to feel a bit miserable, that there's no expectations, price is low, because like then it's much easier to shock the market in a positive way. Because if everybody thinks it's going to be bad or neutral or whatever, or nobody's following the story and nobody cares, nobody has bought in, has been really trying to front run the next catalyst, then it's going to be much easier to shock more people. And there's going to be fewer people that have already planned to sell on the next catalyst. Also, since expectations are low, it means that not too much is priced in. So we're taking less valuation, price to value risk, and it is easier for the catalyst to actually make the current price look cheap in the future. So that's one thing, and that's why I think, as always, I mean, you should always have an idea before you buy something. It's like, what are the win conditions? Why am I buying it at this price? How can I make money on this? Why is it a good thing to buy? I mean, I think you should have, I think being a longer term investor or speculator, however you want to call it, I think it's really sets you up with more win conditions. Because let's take Hercules Silver, for example. Here you had kind of like, the chart here, we had high expectations. It was one of the hottest stocks. I mean, 1 week I think it traded more volume than the rest of the TSXV. So there's just a shit ton of short-term traders that were planning to sell the next catalyst. And the catalyst that came, the assay results, the 3 holes, the closest catalyst, I mean, those holes were decent but not great. So if you have a lot of, and I talked about this before, you have a lot of people that they're buying because they think it's going to go like that, and they get more convinced of that the higher it goes beforehand, because it always feels, there's been a leak or whatever. It's like again, Mr. Market is making you look smart to have held so far. And that's just gonna, if you trust the Mr. Market to do the due diligence for you, you're gonna automatically assume that you're actually smarter and smarter holding the higher it goes and the more paper profits you made. Whereas in reality, it's really the opposite, because the market is, again, very relative, and since it's so short-term focused, we can, come back to the fact that, well, if it's a very well-known stock, it's very hot, etc., that means there's a lot of people that are hyping it up and getting other people hyped up. And when the assay results come, the next catalyst, there's going to be a shit ton of people that have planned to sell regardless of what the actual results are. They don't think about how this is priced relative to how it might look 2 years from now. In that case, they wouldn't be, spamming the forum every day, because, I mean, how does that make sense? If your win condition is like, well, I'm going to do a fire and forget, I'm going to be buying here, then I'm going to, just see that, the case is somewhat on track, and maybe, I'll check back in a year or two, and if they ended up finding nothing, I'm going to be down. This is a high risk, high reward sector after all. But if there is something meaningful here, if I come back in 2 years, that's 2 years worth of drilling. Maybe the price and value is up here. And in that case, that could pay for, X amount of stocks that went down 50%. I mean, that's a long-term, simple, it sounds dumb, but it's like, why not? I mean, why isn't that pretty good strategy? If you have very high blue sky potential, even if blue sky materializes, it means that more and more of the blue sky will have materialized the longer you give the story to play out. Because obviously you can't prove up blue sky in a month. You can prove up more in 12 months. You can prove up even more in 24 and in 36. And if this could grow for 48 months, the longer you've held it under that time period, you just assume that the higher the value will be, and the higher the delta will be from the price you paid 48 months ago, for example, to the future value and price 48 months later. That's also the problem with, the high risk, high reward side of things, that the reward side takes time. But most people take in my opinion, I think I talked about this before, most of us, and I started off doing that, we actually went the high risk, low reward route. I remember some companies where it's like, I was also, pre-discovery place, I was like, hey, if they hit this, if they make a discovery here, this could go up tenfold. The problem, of course, is that it's not going to go up tenfold in a day. If they miss, let's say it goes down 50%. I mean, let's say they have one target. That's the only target they have. There is no, plan B from the company's perspective. They have no other assets. They have one good-looking target. And in the eyes of the market, let's say it's in a poor sentiment environment where people don't have patience for failures. Like you kind of got to hit something in the first 5 drill holes. Otherwise, even if there is a deposit there, and they just didn't hit it, because it's kind of hard even if there is something substantial. Let's say 5 holes. Does that test everything? Depends on the target type, obviously. But still, in the eyes of the market, there might not be more money to actually, drill more than 5 holes, for example. And that was the case in a early pre-discovery play I was in. They had one shot with like 5 holes or something. And in hindsight, it's obviously very stupid of me, because in my mind, it's like, okay, if they hit, which is, I don't know what what the chance of success is. Nobody knows. But it's like, in my mind, I probably thought it was 50%. Maybe it was closer to like, well, no, again, nobody knows, but I think I overestimated the chance of success because it was a totally blind target and all of that. And in reality, what was the risk reward? It was not, okay, even if I was right on the 50% chance of success, and nobody knows again, but it was flawed from the perspective that it's like, well, if they make a discovery, it's not going to go up 1,000% in the day of the assay. If they miss and I know they have no more money, the sentiment is pretty terrible, so they're probably not going to get any more money. But if they do, they will have to dilute like crazy anyway. So it's like 50% minus. That's like, let's say that as a base case. Again, in reality, most discovery stores, they don't open up much more than, I don't know, 50 to 100%. It depends on what the hole is. Are there extreme example where something opens up 200%? Yes, there are. But that's the reality of it, really. That in our heads, we think, well, if this works out, that might be a 10-bagger. But that assumes you hold it for it to become a 10-bagger. And that's actually a legit thing. If you did fire and forget stuff, like, okay, I'm putting in 2% of my capital in this stock, then I'm gonna, wait as long as the story is intact and there's still growth potential. Just simple as that. I'm gonna keep holding the stock. And maybe sell if it gets really ahead of itself, and maybe buy if it gets very undervalued since the story is intact. And if it goes down 50%, sure, maybe I'll hold, maybe I'll sell. If you believe the story is over, you sell minus 50%, you cemented that. But most of the time, again, what we do and what people's plan is again, that you kind of fool yourself to think like, yeah, if this works, I could get a 10-bagger. But what happens in reality, if you take a very high risk on a pre-discovery play, let's say, Maiden, they had already hit copper here, so it's not the same thing at all, but let's say it's a pre-discovery play. Even if it's opens up 50 to 100%, most people will sell there. So in reality, you risked, even if the chance of success would be as high as 50%, which is seldom is, in reality, your strategy was, or in practice, your risk reward was like, well, there's a 50% chance it fails, they have no money or whatever, and you get a minus 50% on your portfolio and you sell out, and that's it. You cemented a 50% loss. And there's a 50% chance that, let's say, there is a discovery, it opens up 50 to 100%, because again, it's not going to make, even if there is a 10-bagger deposit there, it's not going to 10-bag in the first day. Maybe it opens up 100% higher. Okay, that might be net positive expected value if there's a 50-50 chance, but that's seldom where it actually, I mean, if every maiden drill program had a 50% chance to find something of significance, I mean, there would be a lot more success stories around, but there aren't. So it's probably more, closer to 5% or something. And in that case, the risk reward gets absolutely horrible. 95% chance of failure minus 50%, and 5% chance that they'll make a significant discovery, and you get paid 50 to 100%, which is patented to you as a holder. Because if it opens up and they make a discovery and it opens up 100%, then people can get in with a lot more information. All of a sudden, the chance of this being a significant discovery might have jumped from sub 5 to, well, I don't know, much more than that. And if price is only up 100%, maybe it's much better risk reward to get in post discovery, pay 100% more than the holders here. But of course, the holders are going to look kind of smart, and that's what typically happens. You see a lot of people, they, let's say, take credit for stuff that they had no idea were going to happen, and they're like, well, I was smart enough to be in the stock before they made a discovery or whatever. It's like, in my mind, a lot of the times, I think they were stupid for being in. Yes, they got rewarded for it, but it really made no sense because the chance of success probably was low. So they look smart, but actually the smart people would be the ones who actually paid up 100%. The ones that got rewarded with 100%, that might be dumb money. That, got lucky because the risk reward was in reality very poor. Okay, getting back to track here. So win conditions, plan A, plan B. Okay, so what's a theoretical win conditions like in Hercules Silver? Well, if you think the case is intact, I mean, yeah, pretty much. You think that, well, there still might be something significant here. So they might have a very impressive growth profile after, Hercules has spent $25 million, for example. That's like, okay, base case is, if I do a fire and forget here, it's like either it's gonna, and of course starting at a new price after the sell-off. So from this 200 million market cap, for example, if there is actually something significant there, these 3 holes, they were not barn burners, but they're gonna end up finding 1 or more copper porphyries, etc. Obviously there's a very high price to potential future value delta. And the longer you give it, assuming again blue sky materializes, you're probably going to be, have more and more profits the longer you give the case, all else being equal. So that's like one easy, the case is, this could still be something of significance. At 200 million, there's a lot of upside. I need to be right maybe 1 in 10, 10% chance of success, and it might be a good long-term bet, meaning that I only need 1 in 10 of these stories to actually play out, and that's going to at least be neutral, especially if the ones that fail only, quote only, go down 50%, because then you're obviously, if you get cut in half on 9, and you have 1 that actually, I mean, if this went up, let's say, over the next 3 years went up 900%, that would pay for all the other companies, all the other 9 of your 10 stock portfolio going down 100%. But that's way haven't done the short as high, but it's like 900%. That's let's say 2 billion. Is that out of the question? No, not in the isobaric, I would assume. I think that's the kind of price target deposit size they're looking for. But it's like if the 9 other failures went down 50%, then you could get away with let's say 450% returns, whatever, over the next 3 years. That's if you get 1 in 10 right. I mean, I just off the top of my head, the math might not be too accurate, but I hope you get the point. So that's a long-term kind of case. Then in between, it's like, okay, are there any more win conditions? Well, plan B. Let's say, like I discussed when this happened, maybe let's say they do put out some next batch of assays are encouraging, and the quote dream is alive, whatever, and we get a hype train going. So maybe again, depending on how it goes, who knows? And this is assuming that it's becoming obvious that this case is very much intact, despite the fact that here it kind of Mr. Market was signaling that the sky is falling. Then you also have the options like, okay, hype is going up. I like the case, but now I have let's say this is how you see the value curve, for example. Then you have an opportunity to actually, again, not take more assay risk per se, but actually, okay, hype is high again. There's a lot of people in. Everybody's expecting again that the next assay results are going to be good. I mean, now nobody expects that they're going to be good, so I feel more comfortable holding into the next batch of assays here than here. That's why I added a bit again. But if the hype goes up again, then you can, when the odds are getting stacked, at least short term for the holder, because there's more pent-up selling demand, the expectations are higher, like I just talked about. There's got to be more to shock to the results are going to be even better the higher the expectations are to actually have a jump like that from the next batch of assays, for example. Well, not that you predicted it, but all of a sudden you get a chance to, it's like plan B win condition. Okay, hype started. Nothing changed in terms of value really, or not much perhaps, or price changed too much that it overshot the value curve. Well, then you got an opportunity to sell some, and maybe it does the same thing. It sells off, expectations too high, we get a flush again, comes under the value trend, then you can buy a bit more. It's like you don't need to predict everything, but I think you should always have a plan A and preferably like plan B. The more kind of exit potential win conditions, the better. Because if I didn't think the case was intact and I only bought because, well, I think there's going to be some dip buying, and we know that some people trade this kind of, they bought here. You could see in the forum they were talking, pumping it. I mean, that's very positive. And then they sold here, and that's like they're happy. But what do they do if they buy here? And the only plan was like, they don't have a long-term perspective. They're not gonna, they don't even have that as a potential strategy that, hey, this risk-reward on a long-term basis is good enough. So I'm happy buying here because I think the risk-reward long-term is good enough. If their only intention or the only strategy they have, I'm gonna buy here and, I'm hoping to sell a small dip pop, let's say. What happens if it goes down here? What do you do then? You didn't get the only thing you were after, short-term gains. Are you going to sell? All of a sudden it's like you're in no man's land, if you know what I mean. Whereas if you, with no additional information, etc., if it was here, went down here instead, the long-term risk-reward case just got better. If there's no additional news, no additional change to value, but the price went down, that just means, let's say it's down to 170 million here, or 150 million or whatever. All of a sudden, if blue sky materializes, you're going to get even a bigger reward because they have money. They're not going to dilute anytime soon. And then that you need even smaller hit rate. Maybe, instead of 1 in 10, you might need, 0.7 out of 10, if you know what I mean. So it's much more forgiving the cheaper you pay, obviously. So that's the thing. It's like, and if you have that kind of in your back pockets, like I think this is a pretty good risk reward here on a long term basis, because I do think it is intact, and if it is intact, it means in 2 years it's probably going to be a lot higher than here, and I don't need to be right a lot of the time. Then you don't really care, because we're talking, it's like the base case is that after the next 15 news releases, I think there's a okay shot that this looks quite cheap. And if it looks cheap in 15, that probably means that blue sky is intact. Then it's going to look even cheaper after 15 more news releases, probably. So if that's your fallback, that's your base case, then again you can kind of play around that. Okay, if hype goes up a lot, then I also have the possibility to sell sentiment pops on the way. But you still also could, you don't need to do it, I mean, theoretically, because even if the stock price goes, yeah, we have a sentiment pop, it goes down again and then up, because you can see that in Great Bear or Snowline or whatever, yeah, they had very large corrections along the way, but on average, the longer you held those success stories, the higher your return will be. So the people that held Bear Creek from time of discovery for 2 years made more than the ones who held it for 1 year, and the ones that held the most were the ones that or earned the most were the ones that held it for 3 years. They didn't even need to do all these short-term pops. So that's kind of the base case, that you're kind of the long-term trend, current price versus long-term trend potential, the growth potential. But again, you also have, because let's face it, if Hercules Silver just pops 50% in the next 2 weeks on nothing but hype, for whatever reason, but nothing but hype, there's no additional value. That just means price has gone up, but value hasn't gone up. So that means it's a poor risk reward, because there's no change in value, because there's no new information, but price went up 50%. So it's like, I don't know what opportunities the market will give me, either to sell or to buy. But if you have this kind of concept, then you don't really care. Again, if you thought, hey, from a long-term risk reward situation, buying here and just, let's say, theoretically holding for 2 years, I think that's a good bet. If it goes cheaper, that just means the bet is better. If it goes higher, again, with no new information, just means that the risk reward is a bit poorer. There's less upside to blue sky from here, there's more upside to blue sky from here. Less hit rate required here, more hit rate required here. So in that case, I mean, that's the thing, it's like you should use volatility to your advantage, because then you don't really have to get it right, if you know what I mean. But if you're a short-term trader, you need to get the short-term volatility right. That is bloody hard, if you ask me, because again, it's like, what do you do if you buy here in US? Oh, I think I'm gonna make a bit of money. You see people brag about they made 10-15%. It's like, they're bragging about it. It's like, okay, you made 10-15% on how much? And we only see what happened when the pop was up. They wouldn't say that if they bought here and it went down. And what did they do then? Do they buy more? But it's like, well, if your case was only short term, okay, are you expecting it to, I mean, all of a sudden, if you're down 20-30% and you're looking for a short term pop, then you have to add and be even more, I was going to say sure that the next pop is going to be up, because what if it goes down here? It's like, are you going to, I mean, if are you going to try to save the short term trade by just adding more and more, and then you're going to get out when you're even or whatever? It's like, I just think that's one way to like dig your own grave, if you know what I mean. But again, if your base case is the long-term fundamental, the potential of the fundamental future growth trend versus current price, then you can play around with, like, I mean, if you think the case is intact and went like that, I mean, that's not really going to change. If blue sky is up here, you're still going to make whatever return from here to here. Just means that, yeah, it was cheaper for a while, and you look a bit dumb for a while, but that's not really a big problem, because it's like, does it really matter if it went like that or if it went like that? No, not really, especially not if there's no short-term dilution incoming. Because in that case, yes, we know how this sector works, where it's like, it's a negative cycle, where it's like, if they need money, the market knows it, it tends to sell off, which worsens the dilution, which makes even more people to sell, and yada yada yada. That's a context that should be considered, but in this case, that is not a risk even. And another example of this, I think, is NGEX. Okay, they released assays today. Okay, this is the reaction. It's like it opened up higher, sold off. How do you think? What do you think the assays or the catalyst would have been? It's like below expectations, a bit. Again, a small pop, and this kind of proves the point, I think. Opens up higher. There were a few people, and then there's so many people who kind of had high expectations or were expected the results to be good and to be able to sell. So it got a quick response from maybe new people that wasn't following the story, wasn't aware of it. News was good, so they added a bit. And then there's a lot of people probably that were just sitting and waiting and hoping and expecting this to jump so they could start selling. And all of a sudden you have this big red candle. So this is when profit takes place. And that's kind of interesting. It's like those were some beefy intercepts. 62 meters of almost 7% copper equivalent. 63 meters of almost 6% copper equivalent. And still, I don't know if up 0.4%. So you see what I mean here. It's like, by no one's standards were those not great real results. But there's, I don't know, was it only very high expectations? Were there leaks, if you know what I mean, that kind of everybody knew that their results were going to be great, and that's why people were buying, paying higher and higher price the closer we came to it. They're willing to take more and more risk because the price is higher all the way into the assay results, because maybe it was obvious, maybe there were leaks, maybe just people had very high expectations. But that's what you then get. There's everybody was in, and the people who were in were, especially, if you kind of knew the results were going to be good, obviously you bought because you thought you would get a reward and maybe sell into it. So then you have a very muted reaction. If the stock hadn't done like this going into result and more like this, you can bet your ass that it would have popped on this exact news release here. Maybe it would have gone from here to open up here or whatever. And again, that's what my point here. Paid before catalyst or paid after catalyst. If price runs going into assay results, for example, you're already getting paid for the catalyst, and no matter the results. So that's like returns without assay risk. Or you could get flogged going into a catalyst and it's still good, and then you'll get paid after. Let's say it would jump like that. I'm not saying it would, but it's like, is it possible? Yeah, absolutely. Same end result. It's just that here, bad, low expectations going into it, actually paid on the day of the assay results, high expectations going into it, so you were already paid on the run up, and it was kind of, sell the news. Buy the rumor, sell the news story. Okay, so what is the theoretically the worst way to play catalyst, or if you're a catalyst hunter, which most people are, that's obviously buying after the expectations have already significantly gone higher, because you didn't get paid on the expectations. You were the one paying the top dollar for the expectations, and you took the most amount of risk over this entire period of anyone. And even in this case, with great drill results, you didn't even get paid for it. You can imagine what could have happened if they were worse, or much worse than this. Maybe something like, down 20%, 30%, or whatever. So that's the thing. If you're a holder holding into assay results, you really want low expectations, low shatter, even though it's going to feel worse, because there's not going to be a lot of people that are comforting you and, telling you that's like, oh, everybody agrees it's going to be good, so it feels really nice. Mr. Market is ramping and you look smart. It's like, oh, if I've been smart this this far, it must mean I'm doing something right by holding, so I'm going to keep doing what the market has been, patting me on the back for, meaning holding. That's why it's like in Hercules Silver's case, started to take profits up here, and now I, rebought a bit. Because that's the thing. It's like if price is going up on no news, that by default means that the risk reward is getting poorer. Just remember that. And why, really, if we're a holder, we don't want it to be preferably rigged against us. Meaning that, like, if you're a holder, means in this case, for example, which is obvious in hindsight, you don't know that beforehand, but obviously expectations were so high that even very, very good, exceptional results, which happens once in a blue moon, was not enough to give you a short-term reward. And you can imagine what would happen if the reward was less than exceptional. You would get a quick paper loss. And again, if you're only a catalyst hunter, that's the quick. This is what most people do. And you could see that in Western Alaska as well. Expectations were very high because they, announced 100 meters of semi-massive to massive sulfides. So it became a huge sell the news event, because everybody expected that Alaska would shoot through the moon when the assay results were going to be released, because everybody thought it was good. Problem is that it had already kind of shot to the moon, because everybody agreed that this is going to go higher when everybody agreed that the results are probably going to be good, and then we just assume that because they're going to be good, it means we're going to have a positive reaction. Whereas the stock had been pricing in those results, and when it actually came, it was a nothing burger sell the news event. So again, reminder, as a holder going into assays, we want low expectations, because less downside, easier to shock to the upside. As a holder, we don't want too high expectations, a lot of pent-up selling demand, where not even significant news can make it go higher, and there's a high risk for downside. And that's why my example here is like, we don't need to predict it if expectations are low going into the next 10 news releases from Hercules. I mean, that's good from a holder's perspective, because, okay, if we're not pricing in too much of blue sky, low expectations, that means there's more upside risk and less downside risk. Because let's say, I don't know what the exact expectations are now. Let's say the next batch of assays are also mediocre. Maybe it doesn't sell off that much. Maybe it sells off a bit. But what if they're great? Maybe it opens up 50%. And again, the base case, in my opinion, should always be, you should have a time horizon that's always a lot longer than the market. That's the easiest way to get an edge, at least, because everybody's thinking about the next assay results, and that's what and the current sentiment. That's what's dictating the current price. Whereas, like, if your case is built on price today, given poor sentiment or whatever, low expectations, and what this could be in, let's say, I don't know, 2 years or whatever, then it becomes a lot easier. It's like, because if somebody asks me where's Hercules silver, for example, going to go in the next day, week, or month, I have absolutely no idea. What are the next assay results going to be? I have absolutely no idea. The only thing I am pretty sure on is that I think it's impossible to kill that story in 3 drill holes. We know they have 25 million to spend on exploration, and if this ends up being a success, I don't need many of these to work out to pay for a lot of failures. So the base case is the long term. Then the plan B is, again, that's what I said about Condor, for example, that if Condor ran to, like, I don't know, 70 cents or something, that would put me in an awkward position, because I really like the target, but I have already been paid so much, and it's pricing in more, that it might be, you might have been paid enough going into the assay results that is like, it's only sensible to take money off the table because expectations are so high. It's going to be harder to shock to the upside, yada yada yada. But at the same time, you could have let's say you bought here, for example, this is NGEX. You bought here, and your plan was that, well, I'm going to keep holding NGEX until it looks like they can't grow much more. So you just hold, you get paid a lot, before preemptively going into assays. Sure, you were not paid on the assay day, but it's like, well, the plan was to, like, check back in 2 years. That's my strategy. It's like, I have a few that I hold for 2-3 years, and they pay for all the losers that go down 50%. And even if the stock goes something like that, because again, short-term expectations meet short-term catalyst, and it goes, hype, and then fear and whatever. It's like, well, your strategy was simple. It was just a long-term strategy. It's like, yeah, okay, sometimes you get paid beforehand and you're not paid on assay day. Sometimes you get punished because expectations are low, but if the case is actually intact, it's going to jump one day because expectations were too low, and yada yada. And that's why it's like funny with investing. Like, I find myself doing, coming up with, let's say, new hobbies, etc., because pretty much all my holdings, they are long-term focused, meaning that they have plan A, and unless they ramp very high on hype, and I can I can do a let's say, use the short-term positive volatility to take some risk off the table because price has gone up and value's gone up, there's not much to do. Because there's not that much hype in this sector. Even if some of these stores go up 20%, they, that might be, you like a case and it goes from 28 to 32 million, and it's like, yeah, that's a decent jump, and you obviously can take profits because by definition, if price goes up and value hasn't changed, that it's a bit less risk reward. But if you think that, I don't know, blue sky in 2-3 years is 500 million. Is it a big difference if you paid 28 or 32? No, not really. Either it's going to work or it's not going to work. And the upside to 500 million from 28 or 32, it's not that big of a difference. I don't think necessarily you have to do, incredible value shuffling because of every 10% pop or dip or whatever. But sometimes, maybe, you're up 50% on something on mostly hype, then it's okay. I mean, I am up on Condor, for example, but it's like, is it outrageously high already? No. I mean, are the expectations high? I mean, yeah, somewhat, but they added, the tech JV, and price didn't really react. So I mean, that's a de-risking event. Shot at another big price, you have a major that confirms they have a shot at a big price at Cobra Orco. So I mean, that's a net positive, I would say, from both the risk and at least pace of upside, and you have tech's expertise and yada yada yada. But the stock didn't really react. So I mean, I would say the value went up and the price didn't go up. So that obviously makes me a bit more comfortable with today's price being as a holder if price is going up. I mean, if value is going up and price kind of stays the same. Also, a few other things I guess I could add. It's like, takes time to know or feel the case. In my opinion, I think there's a quote by someone, maybe it was Warren Buffett or something. There's like, you don't know the story until you become an investor. I think that's very correct. It's like I take starter positions, let's say in a bunch of stocks, and then it's like, then you start to really do the work, and the more time you have to think about the case and see what, let's say, management does or whatever, you get more and more meat on the bones. You get a firmer idea of how competent the team is. You learn more about the geology or whatever and stuff like that. So it's like, on day one, I mean, maybe you buy take a 1 to 2% position in a junior because you liked it. I mean, you done due diligence. But it's like, price maybe doesn't change much, but you get more and more comfortable. You get more time to just subconsciously think about the case. You learn more. You talk a bit more with management or whatever. You discuss it with more people, and all of a sudden you're like, I'm feeling, the more time goes, I'm feeling better and better about the case. And then you might, hey, I shouldn't have 1 to 2%. I should have 2 to 4% in this case. Maybe that should, all the information kind of was there on the day you bought, but it's like you didn't really have a feel for it. You didn't know it in the same way. So in my opinion, or what typically happens for me is like, it really evolves, like the conviction, let's say, because sometimes I buy in 1-2% position, and then it's like, actually, the more time I've had to think about this and being a shareholder and looking at, again, other cases, because everything is relative. Sometimes I'm selling something I think is a buy, because I simply found something that I think is a better buy, and I have less in that or whatever. So that's also a thing. And of course, in that case, you need to have some kind of holding period for that to really, take the time to think, because it's my impulse buy. I mean, sometimes I buy a stock on impulse, like that looks cheap, but I didn't do much more due diligence. I don't have the conviction. It's like, I sell out a week after, maybe minus 10% or whatever. Should I have bought it in the first place? Maybe, maybe not. But it's like, hey, based on the gut feeling I had at the time, I thought it was worth a punt. But the more I learn about it, maybe the less I like it, whatever. And then there's also liquidity. I mean, what point was I going to make about liquidity? Well, I mean, some holdings I have, for example, there's no way for me to sell my position. It might have taken weeks or something to buy into it because there's such a low float and whatever. Then you obviously even more have to bet on the long-term picture. Because there's like, well, there is not a... I can't even make a short-term trade because I have too much stock. I can't get out of it quickly. I mean, Snowline or Hercules, I mean, there's enough volume that you can have a pretty big position and change your mind in, a day from now and you can get out. But some of these stocks in this kind of environment, you can't do that. So if you don't have a long-term like hodl plan, your plan A ought to be long-term if there's like low liquidity. If there's a lot of liquidity, I mean, you can change your mind a lot more. You're not stuck, if you know what I mean. So in that case, low liquidity stocks, you really need to, and it forces you to be long-term. Unless you, if you're really impulsive and you take a position, you get the price up 20%, and then all of a sudden you change your mind because you didn't really do much due diligence, and then you slam the price by 20%. I mean, that's like you paid up to 20% more than the market just to get in, and then you ran it down 20% just to get out. I mean, that's not a good strategy, obviously. Or not a good setup. So in that case, you really need to be even more sure that, hey, this is a, good long-term risk-reward bet. And as always, like, a lot of people, they judge themselves and especially everyone else on their short-term results. Oh, they're down on that stock, what an idiot, they had a bad year, or that guy had a good year, oh my god, he's great. But like, in reality, you have no idea really when the payoff is. Some years you will have good, some years will be good, some years will be bad. And in this case, we're in a 3-year bear market, which, I mean, it might have ended, but we haven't really had a big leg up. So I mean, it's only natural to have, at face value, poor results over the last 3 years. The flip side is, of course, in a bull market, nobody has a bad year. I mean, from this period here to here, there was not a single junior that was down. For example, or I mean, here to here, I don't think it was that great in juniors, but like GDXJ probably did pretty well. I mean, nobody's losing money in the mining sector over this period of time. Nobody's losing money in the mining sector here. Almost everyone's losing here, or losing here. But it's, as always, it's a long-term thing. I mean, let's say you bought here. Now you look stupid in Hercules. Wait 2 years, maybe. Let's say you just held it. That's why it's like when I see people judge other people based on, it's like, you have no idea what their strategy is. Let's say this person bought here with the simple strategy of like, well, I think this could be something significant. If it becomes something significant, this might look cheap in 2 years and 30 news releases from now. Okay, now he looks stupid. But he sticks to his strategy, simple strategy. He might think that, well, I think there's still a shot that this is a significant discovery. So okay, looking smart, looking stupid, looking smart again, looking like, I don't know, neutral, let's say. But in 2 years, like in Great Bear, some people at specific times, you look very dumb holding Great Bear depending on when you bought. But in the end, in that case at least, every single buy was in the profit at when all was said and done, because it got acquired. It was just degrees of how much you made. But in the meantime, you could have bought Great Bear here and would have been down 40% and looked like a total ass. But 1-2 years later, you would have made 400% or something. So again, everything comes down to strategy. I mean, if let's say my recent past has looked poor, you have paper loss, and that means I think there's a higher chance that the future is going to be even brighter, if you know what I mean. And vice versa. I mean, if you had a really good jump in a lot of stocks, so it's like your portfolio's done, a run like this. I mean, you should not expect that it just runs like that, because that would be a compounding of like, I don't know, 430% in this case 2 months. I mean, you would become a trillionaire in 2 years if you had that kind of compounding, which you obviously are not going to have and shouldn't expect it. So you can kind of assume that Well, there's going to be a profit-taking event sooner or later. So I can't take this too personal, because I got perhaps paid quicker and more than I should, and it overshot the trend. Not that it's expensive relative to the future, but it's a bit expensive based on what we know, perhaps. Then you're gonna have a very punishing 6 months, perhaps. Sentiment low. You're gonna look more stupid than you are, and then. So you can't take these ups and downs too personal. And the whole idea is like with cyclical sectors, the worse the past is, the brighter the future. And it's these major sentiment swings that are supposed to even themselves out, but you can't just be a part of one. Oh, then also I gotta put my skates on, as Quinton would say, because already up to an hour. Goliath put out news today. Goliath intercepts almost 11 grams per ton AU equivalent over 9.7 meters in the Bonanza shear, significantly increases volume and average grade of multi-layered high-grade shorebed system. As always, just an immense news release. Wait, are all these? I don't know if these are released today or if these are... No, these can't be all released today. This must be... highlights from the 23 drill pro. I think. I haven't even had time to go through it. But so it's like I prefer, especially at times like this when it's quite hard to be overpaying for anything, even if it's high quality. What really stuck out to me, and it's like they're leading with that as well. It's like the mineralization model has been updated with the latest assay results, increasing the average grade by 43%. That is a whopper grade increase, and 24% increase in volume from 5.5 million cubic meters at 6.31 grams per ton A equivalent to a volume of the shorebed zone. This is just a shorebed zone to 6.8 million cubic meters with an average grade of 9.04 gram per ton A equivalent, which remains open. This is just a working model, obviously, but that's a monster of a jump, and you can easily do the calculations here. I haven't done them yet, but it's like, okay, 6.8 million cubic meters, I don't know, 2.7 specific gravity, you come up with a tonnage, and then you have 9.04 grams per ton, and then you can come up with a number. It's not like they're gonna be mining 100% of that, but it's like I bet that if you just take 50% of that, that's probably gonna be a multi-million ounce price. And then you also have the Bonanza zone, which here also the volume and grade of the Bonanza shear zone has been increased substantially to 15 million cubic meters at... the grade increase here is just enormous, obviously. Stock, I don't think it has reacted much, but I think Goliath is quite simple. This looks like they're onto a very robust system or systems, and they have even more exploration potential. 84 million Canadian. To me it looks dirt cheap. That's why I just again continue to hold it, because if this is actually very cheap relative to where this looks to be going, one day I should get a big payoff. So if it does materialize to close to blue sky, maybe this will be worth or trading at hundreds of millions of dollars one day. It looks to be coiling quite bigly. If not, I think it's getting increasingly hard to see that this is not going to amount to anything. So I like the risk reward from that perspective. We're getting more confirmation from the more they drill, that this looks like a legit gold deposit in Canada. So I think this is getting cheaper. Looks 85 million looks cheaper and cheaper with kind of every news release. That's I guess why Robin McEwen got in. It's like he's seeing enough that this looks like this could be a good big high grade gold silver mine in Canada. So it's like no surprise. I think the market is absolutely off the rails in terms of this valuation. I think the risk reward is way too good at 85 million Canadian. And again, it's like, should you be complaining about that or not? And that depends on how you look at it. Like I was gonna say, like as a result, you either get paid, you have either gotten paid, or you will get paid, assuming you're correct on the case. So is this again this bear market kind of type thing bad? I mean, I would say the risk reward is probably multiples better at this price than it was here, because risk, it's been de-risked so much more. So is that a good or a bad thing? Again, it's like if you sell, let's say if you sell out here when it's probably the risk reward is probably better than it has ever been, then you're gonna curse at the market because you might have bought here, and let's say you know, oh, I think this is gonna be good, I'm gonna make money, and you just trust Mr. Market, and well, okay, it looks like things have gone bad or nothing is happening, so I'm selling out. Whereas, like, let's say you sold to someone who bought here who thought, well, I think the risk reward is actually better than ever, perhaps, and in 2 years maybe this stock is at $4 or something, and this guy's gonna say, I like this mining sector because it gets so batshit crazy at sentiment lows. The risk reward is just too good. And this stock alone paid for X amount of mistakes, let's say. Whereas again, the person that bought here and sold here is probably gonna curse at the sector, and you know what I mean. It's like, yeah. And then we have Pacific Ridge, intersects 110 meters of 0.97% copper equivalent, or 1.44 grams per ton equivalent within 455.8 meters of 0.43 copper equivalent. Also a relatively beefy news release. I think that's I can't barely see. I think that's hole 68. I mean, that's what, okay, here. Yeah, so this is hole 68 going like that. There's more. There's more stuff, and London 17, for example, he does a lot of. He posts a lot about it, and I think, I mean it's just simple. Okay, 21 million Canadian. Is this a tier 1 porphyry discovery? I don't think so. It's like, is their entire portfolio including Clayule, is that worth just 21.5 million Canadian? I mean, it's pricing in, there's no chance that they have anything that's going to be a mine or of interest. Is that too pessimistic? Well, I think so. I mean, it's the same with Goliath. It's like, I just think the market is way too pessimistic. They're looking at stuff with, let's say a decent chance of becoming something of significance, and they're putting I'm not going to say no chance in hell, but it's like, I think it's way under appreciating a lot of these juniors right now. So and it goes without saying, okay, 21.5 million Canadian. What if they drill, let's say they drill a bit more, let's say they dilute to 30 million, but by then it's like, maybe copper is up, and it's obvious that, yeah, actually Clayule is a pretty decent copper porphyry system in BC, Canada. I mean, to get to 300 million, that's a 10-bagger from that. Is that out of the question that it could be worth 300 million one day? I don't think so. And if it would become that, even if you assume this is actually, including dilution, so we're more like 30 million Canadian, it's like, yeah, okay, you need to be right in 1 in 10 for a 300 million price. That's the problem today. It's like there's much many more stories than I got. I mean, there's more bias than dry powder, if you know what I mean. But it's like, do you need every one of these to succeed? Absolutely not. I mean, it's all about the risk reward. Maybe you'll need to be right 1 in 10. Or if you own 10 Pacific Ridge, maybe one needs to work out to, actually to make a profit if the other 9 goes down 50% from here. That's just how it is. But again, how do you materialize that risk reward? Well, you can't hold them for 1 week or 1 month. You have to kind of play the cases out. The ones that work, if they work, they will go up. The more time you give them, and the ones that fail, I mean, you're gonna. That might be readily obvious, but that's the thing. It's like, to capture the reward side in this sector, you have to hold it for you need to hold the stocks for long periods of time, and that's why it's like, I like the quote by Monish Pabrai: investing is for gentlemen of leisure. It's like, investing is really good if you have a lot of other hobbies, which makes you not care too much about the market. If you can literally just do nothing but wait for cases to play out, which might be 1, 2, 3 years. I think Monish Pabrai has said that typically the average time for his cases to play out after he's bought them, if he thought they were cheap, 3 years. I'm not saying it's the same in the mining sector, but that gives you an idea. It took, on average, according to him, if I remember correctly, it took 3 years for him to look smart, if in the case he was, a good buy doesn't mean that it's gonna provide a good positive return, but the cases that did end up working out might have taken on average 3 years for them to like really show that, or for him to look really smart and actually get a substantial payoff. Anyway, thanks for listening. As always, I'm biased. Some companies I have as banner sponsors, which makes me biased, and a lot of the companies I talk about, most of the companies I talk about, I have shares of, which makes me twice biased. In NGEX case, I don't. I just thought it was a good example, and I mean, now I mean, this was a great. I don't know too much about it, but it's the Lundins. So it's high quality by default. What the actual risk reward is at $1.46 billion. Despite these exceptional results, I don't know. It's like I haven't done enough. I haven't looked into it enough. But who knows? Maybe this lack of reaction again. Let's put it like this: even if, let's say, there has been a leak, or it was so obvious they were going to be good, whatever, so there's no reaction, so the holders feel a bit like, I held because I thought that they were going to get a pop, because I had a good feeling the results were good. They didn't get payoff. Maybe, who knows? Maybe that created an opportunity for latecomers, if you know what I mean. I don't know. I don't own shares of it, so that makes me biased against it by default. But it might be something worth looking into, because again, it's like news release days and how the market reacts, and since it's short-term orientated, that's where typically long-term opportunities come up, or an opportunity to sell, actually, if it's overshooting the long-term trend. Thanks for listening. Not investing advice. Have a great day. Bye.